Welcome to our in-depth guide on the Child and Dependent Care Credit and how it interacts with Dependent Care FSAs. This video will provide you with a comprehensive understanding of these complexities to help you maximize your tax benefits. In this video, we will cover an overview of the Child and Dependent Care Credit, the functioning of Dependent Care FSAs, how FSAs impact your ability to claim the credit, important considerations, and finally, we will walk through an example to illustrate these concepts. The Child and Dependent Care Credit helps offset costs of care needed while you work or search for work. However, the credit amount depends on your adjusted gross income. Generally, both spouses must work or look for work, unless one is unable to work. If you utilize a Dependent Care flexible spending account, it will reduce the child care expenses you can claim for this credit, as these amounts are already tax-advantaged. Dependent Care FSAs allow you to contribute pre-tax dollars to pay for eligible child care expenses, which in turn reduces your taxable income. However, these accounts are restricted to qualified expenses and often have a use it or lose it rule, which means unspent funds are typically forfeited at the end of the year. When contributing to a Dependent Care FSA, these contributions reduce the child care expenses you can claim for the Child and Dependent Care Credit. This interaction does not prevent you from claiming the credit, but lessens the amount of expenses you can claim. For instance, if your child care expenses are $10,000 and you contribute $5,000 to your FSA, you can only claim credit on the remaining $5,000. In our example sequence, we begin with total child care expenses. We then subtract the amount contributed to your FSA to find your remaining eligible expenses, upon which the Child and Dependent Care Credit is calculated. This reduced expense is crucial in understanding how FSAs interact with the tax credit. It is important to ensure that you qualify for both the Child and Dependent Care Credit and the Dependent Care FSA. Consulting a tax professional is advised to receive personalized advice and create strategies that maximize your tax benefits. This provides clarity tailored to your financial situation. Let's test your knowledge. What is a key impact of contributing to a Dependent Care FSA? Option A, increases taxable income. Option B, reduces expenses claimed on credit. Option C, allows for more credit. Or Option D, no impact on tax credit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that contributing to a Dependent Care FSA reduces the expenses you can claim on the Child and Dependent Care Credit. By contributing to an FSA, you benefit from tax advantages which in turn reduce the eligible expenses. To summarize, the Child and Dependent Care Credit is designed to offer financial relief to working families by offsetting child care costs. Dependent Care FSAs allow pre-tax contributions but do reduce credit-eligible expenses. Thus, eligibility criteria and consultation with a tax professional become paramount. Thank you for watching our video. We hope you found it informative. If you enjoyed it, please like, subscribe, and let us know your thoughts in the comments. We appreciate your support and look forward to bringing you more helpful content in the future. Before we wrap up, please note this informational content is intended for general educational purposes only and should not be considered tax advice. We strongly recommend consulting a tax professional for guidance tailored to your specific situation.